Gabriela Santos from JP Morgan Asset Management, able to join us now as well. Gabriela, good to see you. Mike just saying that cyclicals are in a better spot at the moment than perhaps they were a couple of months ago. Are they in a worse spot, though, than they were just maybe a couple of weeks ago with lower stimulus hopes and pending election?
Good to see you, Wilfred. So indeed, we are back today to this virtual world. We've forgotten we'll ever get back to the real world, but we absolutely do think there's space for both. I think in the short term, we still need to answer a few questions to get those cyclical stocks going. When will we get the election result? When will we get a vaccine? And when will we get more fiscal support? Once we answer those questions, then cyclicals really have a lot of upside in our view. But we can't wait to be positioned when we've resolved all those questions. By then, it's too late. So we want to have that balance in portfolios already between the virtual and the real world.
In the meantime, it is rising cases. And Lindsay, this headline just crossing, Illinois suspends indoor dining in Chicago starting on Friday. So it's not a national lockdown, but regionally, these places could start to respond. Are investors off sides for this, even though there were so many warnings about the second wave going into the fall?
You know, I won't be surprised to see more regional announcements like that or city announcements over the coming weeks as the COVID case situation plays out and until we do have better news on a vaccine. As far as investors positioning, I don't think they're caught off sides. There's still a lot of cash on the sidelines that can be put to work here. And so I think, like I said earlier, this is the investor being in a wait and see mode. They have a bit of a tunnel vision right now, looking forward to the election with the uncertainty surrounding that. And there's a little bit of nervousness, as you can see in the VIX and the level that we've seen that rise over the last couple days. And, you know, we expect that to stay elevated going into the election and in the months to follow. So volatility will be a key component of this market going forward. But I think that's just going to give investors more opportunity once we get on the other side of the election and we can remember what we're investing for, which is the future, and that is for 2021. And right now, earnings estimates for 2021 are actually moving slightly higher.
Mike, I mean, some of those fears playing out in the space of 2 days with the likes of the banks, but also the yield curve. I mean, the KBW Banks Index ended down 3% right at its session lows. Wells Fargo is now down 60% year to date, showing, I guess, the ability for those types of stocks to respond more closely to the headlines than perhaps certain other sectors.
For sure, yeah. I mean, and you know, the fact that the Treasury market didn't quite get over the hump there. If you look at the 10-year yield, that rise was halted almost right where a lot of folks would have expected it to on a trading basis. There's a sort of downtrend line. All the technical reasons that you would say, okay, fine, I'll give it room to this point, but now we've pulled back from there. So maybe it's range bound for a while, and there's not a lot else to get people excited about the banks at the moment. So I do think there's a heightened sensitivity to anything that hints of, you know, a relapse for the economy and something of a further slowdown, even if nobody really thinks that we're going to have any kind of full shutdown. And, you know, and in retrospect, it doesn't feel as if it was terribly smart to panic out of the market when we got the Sunbelt surge in cases. And so I do think that's why there's a push-pull in terms of investor positioning and attitudes toward this spell that we're looking at in the fall and the winter.
How are you positioned around technology, Gabriela? Microsoft will go through those numbers right now. We're going to get all the big names on Thursday and right in the middle of some testimony from their CEOs tomorrow.
Well, for us, technology and the whole tech complex is still a theme for the next decade. But the way that we're thinking about it is a lot of portfolios, given the dispersion in performance this year, have gotten very heavily tilted towards that one theme in particular. So we absolutely think it makes sense to take some profits in the space and balance it out with a bit more of the cyclical sectors. And that's true regionally as well. The US, China, very geared towards the tech theme, taking some profit there and rebalancing on more cyclical regions as well, including Europe, Japan, and the rest of emerging markets. It's not giving up on tech. It's just realizing that we do have a chance of catch up for the more cyclical sectors over the next year or so.
Shepard Smith here. Thanks for watching CNBC on YouTube.